Hello, everyone. Welcome to another episode of Firm Returns Weekly. I hope everyone had a good Christmas yesterday that celebrates it. There's quite a bit that happened last week with a number of different portfolio companies, so quite a bit to dig into. And those of you that subscribe to the newsletter will have seen the updates that went out about the TBLD equity raise, probably the biggest headline thing, and then had an update on Christmas Eve, I think, as well, which included just general events of the week, including one probably standout one, which is talks of a merger between Warner Bros. Discovery and Paramount. So we'll get into all of that in this episode. Let me just share my screen. Right. So, first of all, let's have a little quick discussion about. I thought it would be good to maybe talk about some of the underlying factors that have been driving the climb in charter rates we've seen, and just been helping out Taylor Maritime investments. So, if we can understand these driving factors, maybe we can understand a bit more how transitory they are and so on. So, yeah, just first of all, you can see a graph here of the Baltic Handysize Index, which tracks. It's a fairly similar. It's a fairly good comparison for the type of and size of vessel that and actually age as well. I think it's based on something like a 10-year-old Handysize vessel, and I think it's 38 dry weight tons or something like that. Or it would be kilotons, I guess. But so it's fairly comparable to the kind of vessels that TinyBuild has. Not TinyBuild. TinyBuild's on the mind. Taylor Maritime, TMI, has. And you can see here we had a pretty big ramp up. So it had a pretty good run up here from its August lows, and actually it was up something like 70% or something like that from there. It sort of flattened out, but it dipped down, and now it's taken another run up since sort of the end of November. And at this kind of level, we know, I talked about last week, I think, they'd managed to lock in they started locking in some much higher rate charters, so ones at like $14,000 per day, $16,000 a day, even one that was $19,000. So yeah, really starting to get up there in terms of the size, well above where it was. I mean, I think it was around about, at this level, it was around about $1,100 or something. So they're managing to lock them in. I think probably above what this actually represents as well in terms of the equivalent daily charter rate. So yeah, but it's sort of rolling over a little bit now. I'm guessing it's going to kind of, as we'll get on to, it's going to probably soften a little bit and then plateau, but and possibly even go up a bit more. But there's factors in both directions. So the first factor is the drought currently taking place in Panama and also parts of Southern America, that is lowering the water level and basically reducing the volume of traffic that can go through the Panama Canal, which is a key route for a lot of it is ships going from like Brazil or the USA, southern sort of Gulf of Mexico, delivering grain over to China and other parts of Asia. So the alternative they have to do if they don't go through the Panama Canal here is they have to go through the next most efficient route is to go through the Suez Canal and that direction. So the other way around the Earth effectively. And that's still faster than, I think that adds something like 10 days to the journey, but that's still faster than it would take, I think, if they were to go all the way down to the Cape at the bottom of South America. That would add something like 3 to 4 weeks to the journey, or I can't remember the exact figure, but it's way more. So yeah, but so that's just, we've got some figures here. So you can see transits through different locks at the Panama Canal. So we've got the Panamax locks, which there is actually a Panamax class of vessel. So there's like Handysize, Supramax, Ultramax, Panamax, which is the biggest vessel that can get through the Panama Canal. And there's I think there's a Suezmax as well, which is the biggest vessel that can get through the Suez Canal, and that's quite a bit bigger than the Panama Canal. And then there's they've got these Neo Panamax locks now, which I don't know how they compare to Suezmax, but they're a bit bigger. And then you've got like Cape size, which is basically vessels that are too big to get through either the canals, so they're just going to go around the capes. The Cape of Good Hope at the bottom of Africa is probably the most likely. And let's have a look here. So yeah, we can see here that dry bulk has been particularly hard hit by the closure of the reduced traffic permitted through these Panamax locks. It's in just between October and November, it's seen as 47% drop, so really significant. And basically all of these vessels are going through Suez instead, so that's adding 10 days to the journey for those ships, and also for the ones that are going through Panama, there's often maybe a fairly significant queue there as well, so they might be getting delays as well, just not quite as much as the 10 days, which is why they may be sitting there and still going for it. But yeah, the effect of all of this is that it's decreasing the supply, because the vessels are taking longer to get to their destinations at any one time. There's therefore a lower sort of availability of ships. So this is probably the biggest driving factor in the moment for this ramp up in rates. But sort of offsetting this somewhat is the fact that the same droughts that are impacting the Panama Canal water levels are also reducing the crop yield in southern parts of the United States. And I guess I'm not sure about Brazil actually, where they might be in a different situation, but certainly the lower states in the US have been having a lower yield. I think it's something like about 20% lower or something than last year. So that's offsetting a little bit because there's less demand, so it's counterbalancing a bit, and that's kind of what's probably putting a cap on it here. And there's also, I mean, this sort of is coinciding with what's often a fairly seasonally weak period anyway, over the Christmas and New Year holidays, and then getting into around Chinese New Year as well, similar story. So yeah, the end of December to sort of mid-Feb is often a weaker period for charter rates anyway, and so that's probably another force, just a bit of seasonal weakness that's stopping this. Just a lower demand helping to put a cap on the upside for that, for those supply-driven price rises. But something that's but I don't think this Panama Canal issue is going to clear up anytime soon, because it's as I understand it, the rainy they didn't get enough rain in the rainy season, and we're now in the dry season or something along those lines. So it's now a case of it's going to be quite a few months before we get back to the rainy season again, and that things will be coming up. So yeah, the situation is likely to get worse before it gets better. So we could see this drop even more from this point. And there's also, so now we've got these ships diverting through the Suez Canal. That's actually exposing the dry bulk sector, which is normally only about 5% of traffic through the Suez Canal. It's exposing it to greater, it's making it more vulnerable to the geopolitical turbulence happening in that region, and in particular the attacks from Somalian pirates and Houthi rebels in the Red Sea. So there have been several vessels that have been impacted here, and it's actually many of the larger shipping companies. Maersk is one that comes to mind. Those other ones, because a lot of tanker traffic goes through the Suez Canal. I think it's still greater than 20%, whereas it's normally about 5% for dry bulk traffic. So, and then it's even bigger for oil and what have you, I think, as well, because obviously a lot comes out of Saudi Arabia and all those, which are all located in that region. Yeah, these attacks basically are causing a lot of the vessels to divert around the Cape of Good Hope. So rather than going through the Suez Canal, that route, they're going all the way down to the bottom of Africa, which adds, I think, 1 to 2 weeks to the journey on top of that. So you've got the 10 days added, that the fact they're having to divert through the Suez Canal. And then there's also just the other traffic, the 5% traffic that would have gone through there anyway. And then there's, on top of that, the fact they're having to now divert around the southern Cape of Africa. Those two things together is probably going to be, as soon as we start to have demand, if they persist long enough, if this attacks continue, or the threat of the attacks continues in the Suez Canal, with the Panama Canal also having reduced volume, or even in an extreme situation actually fully stops if the water levels get too low, then we could see, as demand starts to ramp up again as we get past the period of seasonal weakness, a serious jump from here, in fact, with rates. So something to keep an eye on, but hopefully it will just, at the very minimum, keep rates at a reasonable level that's going to be profitable for the TMI. So yeah, we will have to follow along with this. But so let's move on to Warner Bros. Discovery. So we heard this week that Warner Bros. Discovery CEO David Zaslav met with Paramount CEO Bob Bakish for what has been rumored to be early merger talks. We'll have to see how things play out, but there are pluses and minuses to such a deal. On the plus side, it would add 60 million streaming subscribers to Warner Bros. Discovery, though there could well be some overlap. And I think because Paramount Plus is currently not profitable, there's probably some of those subscribers that would disappear if they had to increase the rates, for instance, to actually take them into profitability there. So there's maybe that 60 million figure might end up being a bit lower, but it certainly would help to give a real boost. It'd be a quick way of Warner Bros. Discovery adding a jump to their subscriber base, rather than having to sort of slowly grow it organically. So yeah, there's some potential there, and it would also it would further expand Warner Bros. Discovery's IP library. There's content library with things with IP such as Star Trek and Mission Impossible, both being Paramount ones, and then obviously you've got these fairly hit shows over there like Yellowstone and what have you. So Yeah, there's a fair amount of attraction there, but I think it would also result in the creation of the largest movie studio on the planet, which is pretty crazy. Or maybe studio and distribution business. But yeah, the other big players are Disney, Universal, and Sony. So it's like the big five at the moment. So you'd effectively be merging two of those. So that's would be quite a phenomenal thing for it to suddenly become the biggest movie studio on the planet as well. But on the negatives, Paramount is substantially worse financial shape than Warner Brothers, and they'd have to rapidly turn it around before it sank the combined ship. So yeah, there's definitely a risk there. I think they've got something like their debt. I was thinking about, yeah, their leverage ratio is significantly higher than Warner Brothers now. I mean, it fairly comparable to maybe where Warner Brothers was when after the merger, but I think it's like 6.5 something. When Warner Brothers more like 5.75, I think, after the merger. So this is a EBITDA divided by net debt. So it could be a similar. It's a little bit more than that, but the difference is that I don't think they've got the free cash flow coming in to pay that debt down. So, which is why they're in these kind of they're entertaining these kind of merger talks. So yeah, they'd have to do a pretty rapid turnaround there, otherwise that added debt burden is then going to drain. It's going to just be draining all of that free cash flow that is currently being produced by Warner Brothers Discovery. So yeah, it's something they've demonstrated they've done a pretty good job so far with, you know, the Discovery management, which is effectively now the Warner Brothers Discovery management. I've done a pretty good job at really increasing the efficiency and turning around Warner Media so far. So, and I think they did a pretty good job with Scripps, which is a linear TV business that Discovery acquired before as well. So certainly possible that they could manage it, but well, it just seems like they're still not in great shape with the debt. You know, it'd be nice to get the debt maybe to leverage down to, you know, 2.5 times or 2 times before they started thinking about something like this. But I guess if they waited that long, you missed the opportunity. But it seems like John Malone, who's obviously a big shareholder in Warner Bros. Discovery, is quite positive on the idea of doing something like this to consolidate. So yeah, we'll have to see how it plays out and what the terms of the merger are if it comes about. But it's not really what I was hoping for. I thought that they had a pretty good path to expand out into all the markets that Max currently isn't available in. The UK, lots of European countries, and so on. Could have just grown their subscriber base pretty rapidly from that approach as well. We do actually have Paramount Plus here, coincidentally, but not Max or even HBO Max before. So yeah, I'm not quite sure what to make of it. I'll have to wait until I see the full terms of it and all the rest of it before I can have a really solid opinion. But it's yeah, it seems like they had an alternative path, but maybe there's some consolidation going to happen anyway. And it's like if Warner Bros. Discovery doesn't make itself a bit bigger, then it's maybe vulnerable to being pushed out, or you know, some other company comes along and acquires Paramount instead, and then Apple, Amazon, whatever. And that could still happen. You know, we could end up in some kind of bidding war where they come in and offer a higher price and outbid Warner Brothers. But yeah, or Netflix or whatever comes along. So it's kind of, we're in a situation where maybe they're feeling they need to make a move here to make themselves big enough to the point where they're not going to be displaced. What's the other factor here? I mean, yeah, I don't know. I think Warner Bros. Discovery was absolutely fine on its own the business, but yeah, obviously they seem to think this. We just got to hope that it's not just an ego boosting, empire building move from David Zaslav, which is certainly a possibility. And if that's the case, then yeah, this is probably not a good thing. But we'll see. Right, and then just going to move on. So I did in a separate article, a separate newsletter, I talked about the details of the TinyBuild equity raise. So I think I'll shift over to that now, and we can sort of go through here. I'm probably going to read it out fairly verbatim because I do have some strong views at certain points, and and I've tried to lay out all the details and so on as well. So I'll just read it through and not add too much commentary. Keep my head level. Anyway, so on Thursday, the 21st of December, the company sent out an RNS notification explaining, which is regulatory news service, for those who are not familiar, explaining the proposed structure of the equity raise. There are three principal parts: a conditional private placement in which Atari, which is Atari SA, listed in France, will commit $2 million for 31,416,902 shares at a price of 5 pence per share. A conditional placing, so that was the first part. The second part is a conditional placing open only to institutional investors and underwritten by Alex Nishi-Porshik, the CEO, for up to 157,080,000 shares at a price of 5 pence per share, raising a total of $10 million. So just for context, we have 203, just shy of 204 million shares outstanding now. So yeah, as you could probably guess at this point, we're talking about pretty damn substantial dilution. So yeah, we'll get onto that in a bit. But then the third component is an open offer to qualifying stockholders for up to 33,979,706 shares at a price of 5 pence per share, raising $2.16 million if fully subscribed. In this offer, each shareholder is entitled to purchase one share for every 6 they own at a minimum, and can request additional shares in excess of this amount subject to availability, i.e. if other people don't subscribe to their minimum entitlement. Alex can only participate in this offer if it is not fully subscribed, and to the extent that his maximum subscription, including the placing, does not exceed $10 million. In addition to the above, Alex has a special subscription agreement wherein his shareholding cannot fall below 37.8%, his current ownership stake, after dilution. In effect, this means he is entitled to subscribe to a sufficient number of the shares issued in the placing to maintain his ownership at 37.8%. In a scenario where all three components of the fundraise were equally subscribed, 222,476,608 new shares would be issued, meaning any existing shareholder who is unable or unwilling to participate in the open offer would incur dilution of 52.18%, using the currently issued share count of 203,878,238 shares. Put another way, their shares would confer ownership over less than half as much of the company as they did prior to the equity raise. So just shy of 48% is what you'd be left with. It's worth pausing at this point to say that all of the above requires a shareholder vote on several resolutions to be held at a special meeting on the 18th of January 2024, and quite a substantial majority is required, as I'll detail later on. Following the first announcement, Berenberg commenced an accelerated book building process to find institutional investors willing to participate in the placing. It's important to note that this included institutional investors already on the shareholder register, so they had an additional privilege over retail shareholders in accessing a much greater portion of the available shares should they wish to offset their dilution. As it happens, it all came to naught, as later that day, when the results of the placing were published, we found out that only 4 million of the available placing shares had been subscribed, leaving Alex to pick up the remaining 153,080,000. Depending on take-up of the open offer, Alex will be able to subscribe for an additional 4 million shares from there, in line with his commitment to underwrite $10 million. This will mean his subsequent ownership of the company will be between 54.47% and 59.66%, depending on the open offer take-up. So in any eventuality, he will now become majority owner. The following day, 22nd of December, the company sent out a 64-page circular detailing the terms of the open offer and the resolutions they wish to pass at the special meeting. I would encourage all shareholders to read this document and not just rely on what I've written here when making your own judgment. Do factor in that these are the ownership stakes of the directors making the recommendations. So other than Alex, the Chief Executive Officer, who currently has 76,996,000 shares, 100 shares, which is 37.8%. The next highest is Enrique Olivieres, the non-executive chairman, with 51,454, or 0.03%, and everybody else, the CFO, Chaz Salati, and the other two non-executive directors, Neil Cato and Nick Van Dyke, all have nil. So they have absolutely no ownership in the company. And astonishingly, I own more shares than any director except Alex, who is obviously participating in the equity raise, and not one has bought any as the price has fallen. I don't think I can say this of any other company in my portfolio. So something to think on when you're being given recommendations by these directors. The resolutions. 2 resolutions have been tabled, entitled the Disapplication Resolution and the Whitewash Resolution, respectively. You can find their full details on pages 59 and 60 of the circular. So these are the resolutions that are going to be voted on at the special meeting and need to pass in order for this equity raise to consummate. The disapplication resolution allows the company to issue up to 222,481,119 shares at a price of 5 pence per share in connection with the fundraise. It also requires that shareholders waive their right of first offer with respect to the issuance of new shares in this case. In order to pass, 75% of the voting power present in person or represented by proxy at the meeting must vote in favor. So crucial here that you have to actually, it's only the people that vote who are going to be counted toward the total, not voting. It is not 75% of all shareholders, it's 75% of the people who vote, effectively. And then the whitewash resolution allows Alex to increase his ownership percentage in connection with the fundraise without making a takeover offer for the whole company. This will require 50% of the voting power, excluding Alex, present at the meeting to vote in favor. So, yeah, currently he would need, if it's written into the, I think maybe the bylaws of the company or the original articles of incorporation, that he has to, if he wants to increase his stake, he has to make a takeover offer for the whole company. And this resolution would effectively allow him, in this particular case, to increase his stake without making a takeover offer for the whole company. And this same vote, for different circumstances, just to allow him to buy shares on the market, was attempted to be passed at the AGM and didn't. So that's just a bit of context for you there. Management's perspective. The above paints a pretty bleak picture, so I thought it would be beneficial to try and put ourselves in the heads of management, factoring in the discussions I've had with them, one of which took place on Thursday, the 21st of December, which was the day of the announcement of the terms of the equity raise, and the day that the initial book building took place as well. It's possible that Alex would prefer not to pay the full $10 million, which, to be honest, is fair enough. It's obviously a lot of money for him to personally commit into the company. And so they'll have wanted to get participation from other investors, if at all possible. They start testing the waters and get some unexpected interest from multiple strategic partners. These strategic partners obviously want to get the lowest price they can, and Atari is the only one prepared to go as high as 5 pence per share. With a strategic partner in place, they think they'll be able to attract some institutional money in the book build. They also estimate, probably correctly, that retail participation will be low, and the 33,979,706 shares allotted will be ample for anybody who wishes to offset the dilution to do so. There's also, of course, the open market, which is retail investors, or the secondary market that retail investors can access and use without moving the shares too substantially. Though, of course, if they all try to do that, then it would. But yeah, it's not quite the same as someone who's got 10 million shares or something trying to offset the dilution by buying another 10 million shares. They've subsequently discovered that there isn't any institutional interest beyond the aforementioned strategic partner, so Alex will be providing most, if not all, of the $10 million underwritten. In my recent conversation, I asked them 2 pertinent questions which I think most shareholders would like answered. The first was what happened to we can cut development spending to 0 if necessary, as stated in their last earnings call. Their answer was that they've already made significant cuts, including the closure of 2 development studios, and to go further would require cancelling games scheduled for release in 2024 that have a high probability of being profitable and have already incurred millions of dollars in expenses that would be written off if they weren't released. I asked them directly whether these pipeline games that the equity raise is effectively preserving are worth 52% of the company. They said they've run the numbers and do indeed believe the growth in the pipeline is worth more than the rest of the company. To get their thoughts on the likely consequences of the resolutions not passing, here is an excerpt from the circular. Should the fundraise fail to be consummated, the company could seek other forms of funding, although the group's experience of such funds suggests that the terms of such other forms of funding may not be available and/or result in significant value transfer from stockholders. The directors believe that such alternative funding may not be available at commercially acceptable terms or at all, and the directors would need to balance the receipt of funds with the additional cost of such financing. In addition to initiatives to provide additional cash headroom, the company may take action to effect a sale of the business as a whole or disposals of assets, such as the disposal of one of the company's businesses or intellectual property. Given the company's immediate cash flow requirements, the directors believe it is challenging to secure a transaction in an acceptable timeframe, and there can be no guarantee that directors would be able to secure a transaction at a price which they believe is reflective of the full value of the assets being sold. Such a transaction would restrict the company's future growth opportunities and would likely impact the company's ability to maintain or improve its competitive positioning. As a result, if the fundraise does not proceed to completion and the company is unable to implement any of the alternative financing arrangements or other actions set out above, the company would be likely to enter into US Chapter 11 insolvency proceedings. The point at which the company would have to enter into US Chapter 11 insolvency proceedings is fundamentally uncertain, but would likely arise in January 2024, at which point stockholders would lose all or a significant part of the value of their investments in the company. And finally, here's their reasoning for not doing a standard rights issue in which all shareholders would have had equal rights to participate. Had the company made a fully preemptive offer, for example, by way of a rights issue or an uncapped open offer, which might have allowed existing stockholders to subscribe for a larger amount of the overall capital raise, this would have necessitated significant additional cost, reallocation of management time, and a possible delay to the execution of the company's plans. Where do I stand? I lay awake for the whole night on Thursday thinking this over, and have done little else in the days since. I find it utterly repugnant that retail shareholders are not being treated the same as Alex and the institutional shareholders, despite the fact that we all own the same common shares that confer equal rights. No excuses will ever change this for me. Management has taken the gamble of setting the price lower on the completely useless advice that they'd be able to attract institutional money. So Alex didn't have to put up the full $10 million. This has fairly predictably not happened, and shareholders are being subjected to unnecessarily high dilution for the $2 million raised from Atari. Had they instead followed the proposal myself and several other retail investors put to them to raise the $10 million at 12 pence per share, Alex would have had a very similar outcome. He'd likely have provided the full $10 million and ended up with 53% ownership compared to 54 to 59% that he's going to get in this case. All they've gained from their chosen course of action is an extra $2 million in return for 7.5% of the company and the ire of retail shareholders. Maybe they should have paid more heed to the advice given freely by investors in the company than that given by those with no stake or alignment of interests at a total cost of £300,000. That would be Berenberg. Having said all the above, the following may surprise you. As much as I dislike this deal, I think it is the better of the two options available. Here's my reasoning. Should the vote fail to pass, bearing in mind that it's taking place towards the end of January, then short of Alex making an emergency loan, it's very unlikely they'll be able to raise any funding before the cash runs out. This means a takeover, insolvency, stripping for parts, or any number of undesirable courses of action that are entirely out of our control and unlikely to yield more than the circa £20 million valuation implied by the equity raise. I also believe that there is a high probability that games in the pipeline will be commercially successful, and 50% of the cash they and the current portfolio generate in the coming years may well be worth more than 100% of the declining cash flows from the current portfolio alone. So basically here I'm saying that keeping those games might in the long run turn out to be better than cutting all development spending and just living off the current cash flows, which would decline, and probably more rapidly if spending was cut. There's also the human factor. While many investors may strive to be cold, rational decision makers, the reality of taking a company and stripping it for assets carries a very human cost. Cutting all development spending and just taking the cash flows from the existing portfolio means firing all the staff, many of which have been displaced by the Russia-Ukraine war. Any kind of insolvency would have the same result absent a complete takeover. Even Warren Buffett, arguably the world's greatest investor, found he didn't have the stomach for this type of investing when he had some early experience of it during his partnership days. You might be a little further from the action, but that doesn't mean the reality changes. I don't think, as many people have said, that this is all a scheme for Alex to gain control of the company at a cheap price. The reason being that were the placing an open offer to be fully subscribed, he wouldn't have been able to increase his stake at all. In my mind, the course taken comes down to a misguided view that they'd be able to get greater institutional participation and Alex wouldn't need to make such a large contribution. In any case, I will be voting in favor of the resolutions as much as it pains me to do so. So, subsequent to that article, we found out the news that Versus Evil has been shut down. Obviously, I think there was something like, at this point, 12 employees left there. From when they acquired them, it was around 50. So yeah, it's they'd already reduced down significantly. But yeah, obviously sad people to lose their jobs and what have you. But it's that studio has been underperforming for pretty much the entire time. Then probably some sabotage going on there from the general manager, who was the prior owner, as we know from the lawsuit and him having to basically be paid off. And this shows that, yeah, they were true. Tiny Will's management has been true to their word in taking, being effectively being blocked by the legal action and being forced to take a less than ideal deal. Bearing in mind they probably could have won had they had the means to drag it out and continue legal proceedings, but they couldn't really do anything with the company while that was happening. And right now, with their liquidity constraints and so on, the best option was just to settle. And now that has obviously enabled them to take the strategic action, which has been shutting down Versus Evil. Don't know what's happening with Red Cerberus. I think that was still a profitable business. I don't see any reason why they would, and it's quite separate from Versus Evil. So I haven't heard any news about that being shut down. That's potentially something that could be sold off. It's quite an attractive business from what I understand. It either needs to be grown because it's not quite big enough to be optimally efficient, or it could be sold to another player, a larger player or something like that in Brazil, that would be able to just bring on those additional staff onto the payroll, and that would allow and the connections and what have you with Red Cerberus to help them grow and improve their overall efficiency and so on. And all as I understand, the pipeline of games that was being published by Versus Evil will now be published by TinyBuild. They're still obviously being developed, and I don't know about the more marginal ones, but certainly the one I know about is Broken Roads. They've put out a statement. The developers have said this game's still going on, So yeah, it's not a happy result, but a necessary one that significantly de-risks the company and removes a drain on its resources. So I think that pretty much sums it up for this week. Again, hope everybody had a good Christmas that celebrates it, and everyone has a good New Year. I think it will be. Have a look here. Oh, there might be another episode before then, but anyway, I'll say Happy New Year anyway. Yeah. Please. I mean, obviously, this video came out a few days after these write-ups, so if you want to get first or read along while I'm writing, you can find them over on firmreturns.com. Do sign up there, because they will always the newsletters will always go out first before the videos and audio. And if you're watching this on YouTube, give it a like, give it a subscribe. If you're on a podcast player, follow it. That's all be much appreciated. And please do if you're finding these valuable, interesting, enjoyable, whatever, please do consider sharing it with friends or other people that might be interested, as it really helps to grow the overall audience and get it out to people. But on that, I will leave it, and I will see you all next time, possibly next year. Possibly will be next year.